Good morning, I'm Kristine Sullivan, Wholesale Marketing Rep for Sprague Energy. Welcome to Sprague's Refined Products Review, where we discuss what's moving the market, giving you insight into what we're seeing every day. Today is Wednesday, May 7th. Since last speaking with you at the end of March, the U.S. oil market has experienced significant volatility, influenced by a combination of geopolitical tensions, shifting supply-demand dynamics, and evolving trade policies. Crude oil prices have dropped by over $10 since then to roughly $58 per barrel, or 15%, driven by concerns over global economic growth, increased supply, and escalating trade tensions. Global economic growth, or perhaps lack thereof. China is showing inconsistent economic performance. Shocker. They are the world's largest crude oil importer. However, weak industrial output and poor consumer demand have raised doubts about sustained oil consumption growth. Europe and the good old US of A are also showing signs of weaker economic activity, such as weaker manufacturing data and cautious consumer spending. Could there be a mild recession? If so, we'll see less energy demand in the industrial and transportation sectors. Increased supply. OPEC Plus has been considering increasing production in the second half of the year rather than keeping with voluntary cuts they've maintained since the beginning of the year. It appears crude production in the U.S. remains at record levels as well. Over 13.5 million barrels per day. I guess break-even prices for U.S. producers are lower than past levels, so they're letting oil rip. Escalating trade tensions. Until tariff agreements are made, whether directly or indirectly related to oil, markets will continue to be volatile. Technical support lies around $56 to $57 per barrel for crude. This means if the price for crude oil can settle at or below this number, prices will continue to fall until the market's next support level, which analysts are suggesting is $55 or even $50. Back to the $10 drop in crude oil prices. How does this translate into heating oil prices, specifically in October to April heat curve contract? As crude oil came down $10, the price for an October to April heat curve came down approximately 26 cents per gallon, hovering right over the $2 level. This was only a week into April and not a bad time to start layering in fixed forwards to cover your pre-buy programs for customers. And if you didn't jump in then, that opportunity went just as quickly as it came. However, no fear, because the market is giving you another chance at roughly the same levels after creeping up through the rest of April. How will May play out? The majority of dealers I've spoken with, my father-in-law too, believe prices are going to go lower and therefore are still on the sidelines as far as locking in physical supply. In New Hampshire specifically though, the May 1st deadline to register with the state your intent to sell pre-buy heating oil contracts has come and gone. The registration just states that the retailer has secured fuel supply for the delivery of prepaid contracts, whether that be with forward heating oil contracts, locked in with their wholesaler, or physical inventory on hand to cover those obligations. The last option is to turn that collected prepaid money into the state to hold on to until contract deliveries are made. If homeowners are looking to have their cake and eat it too, you can certainly offer them a fixed cap price to protect them from possible higher prices in the winter with the security of downside protection if prices bottom out. The premium for that peace of mind is currently less than 25 cents per gallon, which could be passed along to the homeowner for only $25 a month, assuming usage is 1,000 gallons with a 10-month budget program. This type of program and security isn't for everyone, and it's sometimes more popular when flat pricing is slightly higher, but it is an option and a program Sprague offers if that's something that you're interested in. In fact, my colleagues Will Beck and Kristen Schweitzer discussed Sprague's FizzCap contract offering at the 6:30 marker of their March 28th special feature on Sprague's Forward Contracts Overview, still available on Sprague's YouTube channel. Each week, our refined products review videos have reminded viewers that a fixed price contract with Sprague is just that, a fixed price. It won't be higher than the price that was agreed on by both parties, and it won't be lower unless you pay the premium for downside insurance. Last week, our newest team member, Chris Brennan, made another good point that I thought was worth repeating. The general terms and conditions of Sprague's Master Distillate and Gasoline Sales Agreement entered into between the contract buyer and Sprague that has been in circulation for the 25 plus years I've been employed here have not had any new tariff-related language added to it. Again, this is because Sprague will continue to source non-tariff U.S. fuel supply to avoid any line item, tariffs, duties, taxes, or fees. If you haven't seen it yet, check out our April feature, an overview of Sprague's marine fuel offerings available now on our YouTube channel. That's all for today. Thanks for joining us. We'll be back next Wednesday with another refined products review. Refine your insight, fuel your success.